Hello, good afternoon again, and this is your Prof. Zeus, and welcome to another session of financial accounting and reporting. And for this afternoon, we'll continue our discussion about bonds. Okay, so far what we have discussed with regard to bonds is issuance of bonds during interest payment dates. Okay, so what if the bonds were issued in between interest payment dates? For example, the company pays every December 31st and the bonds are dated January 1. So what if the bonds were issued not January 1 but rather say March 1, June 1, dates other than January 1? So how are we going to account for that? And of course, we'll also discuss about retirement of bonds. So what are we going to do and what we have to look for when bonds are retired by the bond issuer. Now, is that possible? Yes, of course, because it's one way of the issuer saving a lot of money in terms of interest. If he has the money to retire the bonds, then might as well retire the bonds so he can save future interest payments. Okay, and then of course that would improve profitability of the bond issuer. Okay, so that's very much possible. So what are the things that we have to do and we have to note when bonds are retired? Okay, let's go back to the drawing table. Okay, so as I mentioned earlier, what if, for example, bonds were not issued at interest payment dates? Okay, so say for example, let's have this. So let us assume that bonds pay interest every December 31st. Okay, so these are interest payment dates. So what if the bond was issued, say, July 1? Okay, the bonds were issued July 1. So what are we going to do? Well, essentially, what the bond issuer would do is to ask the bond investor to pay the interest pertaining to this portion, the one when the bond is still with the bond issuer. Why is that? Because at the end of the year, which is December 31st, which is an interest payment date, the bond issuer will pay the whole amount of interest. Okay, so this is 12 months. He will pay 12 months of interest. That's why he will first ask the bond investor to pay the other half, no? The one from January 1 up to June 30. So he can get the full amount of interest at December 31. Okay, so therefore, part of the proceeds now will be the accrued interest. Okay, so let us assume that AEG again, okay, say on July 1, 2019, issued a 5 million bonds, okay, that pays interest at, say for example, 12%, while the effective is 6%. Now, instead of, say for example, computing for, let's say it's a 5-year bond, computing for the present value, okay, another way of expressing the issue price is by percentage. So let us assume it's 110. So that means that the bonds were issued at 110% of the face value. Okay, so therefore, the proceeds from the issuance of the shares would comprise of proceeds from issuance, would comprise of the proceeds from the bonds, okay, bonds proceeds, and of course we add the accrued interest. Okay, so therefore, so that is 5 million times 1.1. So this is 5,500,000. And then the accrued interest, of course, is equal to the 5 million interest times 12% times 6 over 12. Okay, so 5 million times 0.12 times 6 divided by 12. So this is 300,000. So therefore, the total proceeds from bond issuance is 5,800,000. So how are we going to record this issuance of the bond? Okay, so you will debit cash for the total proceeds of 5,800,000. Then credit bonds payable for 5 million. And then credit the premium on bonds payable for 500,000. And then credit your interest expense for 300,000. So if you look at your interest expense, okay, there's a credit balance of 300,000. If we do our the account analysis for interest expense, what are you going to have? So you will have a credit balance of interest expense on July 1 for 300,000. Now this is a normal balance of interest because interest expense has a normal debit balance. However, by December 31, when the company then will issue the check, okay, for the payment of the interest from January 1 to December 31st. So therefore, there's going to be an entry debiting interest expense and of course crediting cash, and that is for how much? That's for 600,000. And after we post, if we post this transaction 600,000, then therefore the interest expense would be equal to 300,000, but now it's a debit balance, and the debit balance actually corresponds to the interest from, this is the interest from July 1 up to December 31st. Okay, not the whole 60,000, although they paid 60,000, but it's just a reimbursement because it was reimbursed by the bond investor at the start of the transaction. Okay, so this is what will happen. Then you just have to amortize the premium and then pay the interest. Okay, so this is what will happen if the bonds were issued in between interest payment date. Now, number two, what if the bonds were retired? Now, during the life of the bond, during the term of the bond, okay, this one, say it's a 3-year bond. What if after 2.5 years, the bond issuer decided to retire the bonds? Retirement. Is that possible? Yes, because this will save a lot of money from the point of view of the bond issuer. Okay, because he doesn't have to pay for the rest of the term of the bond if he has the money to pay it now, so he saves on the interest. So what will happen is that, number one, for bond retirement, we have to take note of this. Okay, number one, we have to compute for the carrying value. So compute for the updated carrying value of the bonds. Okay, and when we speak of the updated carrying value of the bonds, we mean what is the face amount of the bond plus or minus. It's going to be plus any unamortized premium or minus any unamortized discount. Okay, so this is the carrying value of the bond. Okay, and then of course we have to also consider the any accrued interest, especially if compute for the accrued interest, no? Because if the bond retirement will be done at any dates other than the interest payment date, then you have to compute for the accrued interest and you have to pay that to the bond investor, and of course compute for the gain or loss on bond redemption, on bond retirement. Okay, so how do we compute for the gain or loss on bond retirement? We just have to compare the retirement price with the carrying value of the bond as of the retirement date. So this is now your gain or loss on bond retirement. Now, if the retirement price is higher than the carrying value of the obligation, then the retirement actually is a loss. Because you have to pay more than the carrying value of the obligation in the book, so therefore it is a there's a loss on the bond retirement. But if it's the other way around, then you're actually giving lesser money, okay, for and then in settlement of a larger amount of obligation, then there's a gain on bond retirement. Okay, let's have an example. So let us assume that okay, so on January 1, 2019, AEG Corp floated bonds of say 5 million, okay, that pays interest at say 12%, Okay, and it's a 5-year bond. Okay, the effective interest is 6%. Okay, so how are we going to do this? So um, now let us again have another one. Say on July 1, 2021, AEG retired the bonds at say 105, meaning retire the bonds at 105%. Now, why is this? Because of course, if I am the investor, at the time that you needed money, I allowed you to borrow money from me, so I'm expecting fairly good amount of cash flows for the interest. So if you're going to curtail the interest payment, then I may have to ask you for some premium, okay, so that it could somehow compensate for the lost interest on my part, on the part of the bond investor. Okay, especially in this case, so 2019, if it's a 5-year bond, so 2019, 2021, 22, 23 until 2023, but he has retired the bonds 2021. So there's a lot of interest that would be missed by the opportunity cost that will be missed by the bond investor. Okay, so first, let us do the entries. Okay, so present value of the principal is 5 million, and then present value of the interest, looking for it. Okay, so that is 6%, so 1.06. 1, 2, 3, 4, 5, assuming that's every December 31st. Okay, so times 0.7472, and then interest is how much? That's going to be 5 million times 0.12, that is 600,000, multiplied by, okay, so that would be 1.06, 1, 2, 3, 4, 5, minus 1 divided by 0.06, that is 4.123. Okay, so 5 million times 0.7472, this is 3,736,000, and then 600,000 times 4.2123 is 2,527,380. So therefore, the issue price is 6,263,380. So this is the total issue price of the bonds. Okay, so let's have an entry. Debit cash for 6,263,380. Credit bonds payable for how much? For 5 million pesos. And credit premium on bonds for how much? For 1,263,380. Okay, so that is the initial recognition. Okay, and then what are we going to do? Every December 31st, we have to recognize the interest and the amortization of the premium. Okay, so let us do the interest, the amortization. Okay, let's do the amortization table. Okay, so we have the date, then we have the effective interest, and then the nominal interest, and then the amortization, and then the carrying value of the obligation. Okay, so therefore, on January 1, the carrying value is 6,263,380. Okay, on December 31, 2019, nominal interest is how much? 600,000. While the effective is how much? 6,263,380 times 0.06. It's going to be 375,000. 823. So 375,803 minus 600,000. So this will be 224,197. Right? 197. So deduct minus 6263, 380. Sorry. 6263, 380 minus 224197. So this is 6,039,183. Right? December 31, 2020. So again, times 0.06. So this is 362,351. And this is 600,000. 600,000 minus 362,351. So this is 237,649 minus 6,039,183. 5,801,534. And then 12/31/2021. Okay, so times 406, that's 348,092. And this is 600,000. So therefore 600,000 minus 348,092. This is 251,908. So therefore minus 501,534. This is 5,549,626. Okay, and then another one, 12/31/2022. So this is 600,000 times 0.06, 332,978. 600,000 minus 332,978. 267,022 minus 5549. 5549. 66 minus 6267,022. 5,282,604. And then the last one, 31/2023. So this is 600,000 again. So this should be 500,000. So the amortization should be 282,604. We adjust at the last amortization. So therefore, 600,000 minus 282,604. So this must have been 317,396. So this is the full amortization table. Okay. Now, so what are we going to do is to update. Okay, because it was retired July 1, 2021. Okay, so therefore, as of December 31st, 2020, the carrying value of the obligation is 5,801,534. This is the carrying value on December 31, 2020, but it was retired July 1, 2021. In 2021, the amortization is 251,908. So we just have to deduct. Okay, so from here we deduct the amortization of premium. That is 251,908 times 6/12. So 251,908 times 6 divided by 12. So this is 125,954. So therefore, the carrying value is 5,801,534, 5,675,580. So this is the carrying value of the bond. How about the interest? Is there an interest? Is there an accrued interest? Yes, there is, because it was at July 1, so December 31st will be the interest payment. So we have to compute for the half year. So that's going to be times 12% times 6/12. So this is 300,000, no? 300,000. Okay? So therefore, how much is the retirement price? Retirement price is 105%. So it's going to be 5 million times 105%. So how much is that? So 5 million times 1.05. So this is 5,250,000 Okay, so there's a difference of 567,580. 425,580. So what is this? If you look at the sample, the given, no? You are going to retire the bonds at 5,250,000, but the carrying amount is 5,675,000. So it will require you lesser amount of money. So therefore, there is a gain on bond redemption. Okay. So let us now do the entry. How much is the total cash that the company will have to pay? The accrued interest plus the retirement price of the bond, which is 5,250,000. So therefore, how much is that? 300,000 plus 5,250. 5,250, 5,250,000 plus the retirement price of 300, so that's 5,550,000. This is the total cash that will have to be spent, okay, by the bond issuer in order to settle the obligation. So let us now do the entry. So we are going to retire, so debit bonds payable. Debit bonds payable for the price. Sorry, for the principal amount of 5 million. Okay, and then what else? We are now going to credit. Okay, there is still a premium of 600,000, right? So we have to remove the premium. So debit premium, because we are now going to extinguish the obligation. Premium on bonds payable. How much is that? 675,580. So that is the premium we're going to eliminate. Okay, and then of course we'll have to pay the interest expense of, that's 300,000. Okay, what else? And then we have to pay cash for the 5,550,000. So therefore, how much is the difference? That's 5 million plus 675,580 plus 300,000. That's 5,975,580 minus 5 the credit amount. So this one is what? This is a credit balance, 425,580, and this is your gain on bond redemption or bond retirement. Okay, so this is our entry. So the 425,580 is actually this one. So this is your gain on bond redemption, and that is the carrying value of the bond, which is 5,675,580 minus the retirement price of 105% of 5 million is 5,250,000. So there is a gain, okay, of 425,000. Now, if this is higher, say for example that is 110. So assuming that's 110, 5 million, or assuming it's 1.20, so 120 is 6 million less 5,675,580. Then this 324,000 would be considered as a loss on bond retirement. Okay, so that is bond retirement. Okay, so let's try to solve some exercises here. So let's have it here. Again, we're using the book of Mamiglio, Intermediate Accounting, Volume 1, 2019, by Dr. Patricia M. Empleo. Okay, so let's have this one, MC34. Okay, so on December 31, 2019, the liability section of Texas Company's statement of financial position included bonds payable of 10 million and an amortized premium on bonds payable of 180,000. So the 180 actually pertains to the whole amount. Okay. Further verification revealed that these bonds were issued on December 31, 2017 and will become due on December 31, 2027. So it has a long way to go, right? 19. Okay, and then 2027, it was retired. Interest is payable every June 13, December 31. April 1, 2020, Texas retired 4 million of these bonds at 97 plus accrued interest. So the question is, how much is the total amount of cash? So the total amount of cash, okay, let us look here. So the total amount of cash that will be paid will be equivalent to the retirement price of the bond and of course any accrued interest on the bond itself. Okay, so therefore, Let us now do MC34. So we have the retirement price. The retirement price of the bond is 97. So 4 million times 97%. So 4 million times 0.97. So that's 3,880,000. Then we add the accrued interest. And the accrued interest is, the interest payment date is every June and December. So April 1 was the date of retirement. So therefore, we will have to accrue January to March. So that's going to be 3 months. So that's going to be 4 million times 12% interest times 3 over 12. That is how much? 4 million times 12 times 3 divided by 12. So that is 120,000. So plus 120,000. So therefore plus 380. So total cash to be paid is 4 million pesos. Is there 4 million in the choices? Yes, so that is letter B. Okay. Okay, let's talk about this one. MC33. MC33, okay, it's actually bonds with convertible warrants, okay, or detachable warrants. Now, what does it mean? The company is actually issuing two things, no? Two items. It's going to be the bonds, that's the bond, and the warrants. So for a single price, they're issuing two instruments, the bonds and the warrants. So what are we going to do? Now, just like what we discussed in other topics on in financial accounting that involves two or more items, we're going to make an allocation. Okay? Allocation of the single price among the items that were purchased. Now, for bonds and warrants, we can do the residual method. Now, wherein we first deduct the we first determine how much is the cost of the warrant. How much is the cost of the bond without the warrant, and then deduct that from the issue price of the bonds with the warrant. So the remaining figure would be the warrant, okay, the amount that can be attributable to the warrant. Okay, so for example, so how much is the issue price? So total issue price is, that includes the bond and the warrants, right? That is 2,120,000. So this is the total issue price of the bonds with the warrants, okay? Now, but how much is the bond without the warrant? Okay, so bond without the warrant, bonds without warrant, okay, it says there without warrant, that's 1,040. So for every 1,000, it's 1,040. So 1,000, that will be issued at 40. No, so sorry, how many bonds were issued? That's 2 million divided by 1,000. So that's 2,000 pala. 2,000 bonds times 1,040. 1,040, that would be 2,080,000. So 2,080,000 is actually the price of the bond without the warrant. Okay? And so therefore, how are we going to do this? The face amount of the bonds is what? 2 million. So therefore, the remaining 80,000 would be the premium on the bonds. And the difference between these two is the 2,120,000 minus 2,080,000. This is now the amount that is, okay, this is the amount assigned to the warrants. I'm sorry. So this one is the amount that is assigned to the warrants, and the difference between the total issue price and the issue price of the bonds without the warrants. So that's 40,000 pesos. Okay. But the question pala dito is credit to premium. So the premium is 80,000 pesos. Is there 80,000 here? Yes, that's that will be. Okay, so how are we going to do this entry? So debit cash for 2,120,000. Credit bonds payable. Bonds payable is 2 million. Credit premium on bonds. Which is 80,000 pesos. And of course the warrant, no? Warrants outstanding. For how much? That's 40,000 pesos. Okay, so this will be the entry for this type of problem, no? Bonds issued with detachable warrant. Okay. Let's have MC32. This is quite interesting. So how much would Florida receive from the issuance of the bonds? So on July 1, 2019, Florida Corporation issued at 97 plus accrued interest 2,000 of its 10% 1,000 bonds. The bonds were dated January 1, 2019 and matured April 1, 2027. Interest is payable semi-annually on April 1 and October 1. Okay, so the question is how much cash is going to be received. Okay, so therefore, first and foremost is the issue price of the bond. Okay, because the bonds were issued at 97 meaning 97% of the face amount plus the accrued interest. So that is the total amount. So that's MC32. So therefore, the issue price, which is equal to 2,000 of its 1,000 bonds times it was issued at 97. Okay, so therefore 2,000 times 1,000 times 97, that's 1,940,000. Okay, and then we add the accrued interest. Because the bonds payable every April, okay, April. So April is the interest payment date, and then they issued it in July, so April, May, June, 3 months. So therefore, that's 2 million times 10% times 3 over 12. So that's 2 million times 0.10 times 3 divided by 12. So that would be 50,000 pesos. So therefore, the total amount of cash that he would receive from the bond issuance is 1,990,000. Okay, so do we have as one of the choices 1,990,000? So that is letter A. Okay, so far we're almost done with bonds. What is left is the troubled debt restructuring of the bonds, which we will discuss in the next session. Okay, this is again your financial accounting and reporting, and we have solved some exercises from the book that we're using, that is of Ma'am Patricia Empleo. Thank you very much, Ma'am, for providing such wonderful problems for the students to practice the concepts. Okay, again, this has been Prof. Zeus, and I'd like to invite you to please subscribe to my channel for you to learn more about financial accounting and other accounting subjects for that matter. And I'll see you again in the next session. Okay, and please continue to pray for for the medical condition I'm having right now. Okay, so I can teach you more in the coming sessions. Thank you very much, guys, and again, please subscribe and do click the bell button for you to be notified whenever I upload the new videos. Thank you, guys, and stay safe, stay at home, okay, and then of course don't forget to pray. Thank you very much, guys.